Welcome back, ladies and gentlemen. You're watching Startup Central, and let's shift our focus to some news coming in from IT. Well, TCS reported a mixed set of numbers yesterday for the first quarter of FY26. The IT bellwether reported a marginal drop in quarterly revenue at 63,437 crores as compared to the last quarter. Meanwhile, profits for the company, that figure rose roughly around 4.5% to reach 12,760 crores, and that also surpassed analyst expectations. In fact, the total contract value for the quarter for the company stood at $9.4 billion. Talking about the quarter gone by, in fact, the company's management said last evening that continued global macroeconomic and geopolitical uncertainties, they have caused a demand contraction in the quarter gone by. In fact, since we're talking about numbers, let's also revisit ET Now's editor-in-chief Nikunj Dalmia's take on the same. Let's listen in.
At higher level, I don't think there is going to be institutional appetite for TCS. Why? Because for IT, I think markets are pretty much convinced that the big picture is a sector which is struggling to grow at 10% also. And if a sector which is struggling to grow at 10% also, where valuations in case of TCS are north of 20, so then price versus value discomfort, I think, seems to be there. The fact that, I mean, you have to look at, TCS, Shishti, does not give a commentary. So then how do you judge the numbers? You look at what the guidance is, which is for manpower hiring, wage hike. What are they saying in terms of where margins are likely to move? What are they saying in terms of the quality of order book? On all that account, while they are not contracting, so the business is not contracting, but I don't see they are at the turn where you could say the cycle has started again. So you buy IT when you know a cycle is turning. Like COVID, post-COVID, the cycle turned for digital. Post-AI, the cycle came down. I don't think there is early evidence based on TCS or what we heard from Accenture that the cycle is turning. We are more for the same. Buybacks and dividends will save these stocks from a free fall, and that's about it. The purist would say that it is cheap, but I would say that there are better options when you're buying companies at P multiples of 20 plus with a 7-8% growth. There are a lot of other stocks in the market, and I think that is where I think the flip is happening.
All right, so that's analyzing the numbers. But ladies and gentlemen, let's hear it out then from the top boss of the IT bellwether TCS, all about numbers, attrition, AI adoption, business outlook, and of course, going forward, what exactly are they penciling in for the company, given the fact that this year up till now has been rather topsy-turvy. It has been a little uncertain, but for how long is the company looking at this uncertainty to carry on? Let's look at this interaction that my colleague Ankur Mishra had with the top brass of TCS.
People are in a wait and watch mode, and I have a feeling maybe once these discussions are over, maybe by sometime in July and August, there will be greater clarity on the direction the trade discussions take, and also the new bill will be in place that will also provide more clarity. I think maybe first week of August onwards we should see more definitive direction in the market.
Aarti, I was really impressed with the choice of words you have made in the release of use case-based approach to ROI-led scaling of AI. I want to understand from you, are there new areas which you are focusing on, and what is this approach which you want to apply now?
So, hello, Ankur. Great to be here. With the initial days of Gen AI, right, everybody was in experimental mode, trying to understand what the technology is and what it can deliver. But I think after 2-3 years now, I think the power of the technology is well understood. So what customers are looking at is how do they shift from experimentation to, which is a use case based, to delivering projects which deliver a business value. So that's the shift we are seeing. And if you really see, from the new age revenues perspective, new services revenues perspective, whether it's AI, whether it's cybersecurity, or you take public cloud, or TCS Interactive, and many of these new service lines have grown well in this quarter and continue to have a good demand. And what we are doing is, in terms of investing in these areas, and especially talking about AI, we're looking at building industry-specific solutions bespoke for a customer, And we are also investing in building agentic AI solutions, which are industry solutions that we can take to customers proactively, where we can go and do these rapid build projects, which can deliver short projects but can deliver value faster. And that's one of the initiatives that we are driving.
Our guiding beacon remains at 26 to 28. It is our long-term understanding of where we want to operate in, and the cost structures which we have do pose us. But if you see the current margin at 24.5, that is largely given the macroeconomic environment we are in. And if we look at this quarter, we had 30 basis points improvement in spite of investing in building capacity and investing in continuing our investments for long-term growth.
Milind, the attrition has been at 13.8%. Is it under your comfort zone, or you want it to be better?
Our comfort zone is, like I always say, 11 to 13%. It is a little higher than that, and we continue to basically do all the actions to basically make sure that we bring it under our comfort zone. So whether it's employee engagement, whatever we need to do for our people, we'll continue to do and bring it down to our comfort limits.
Also, talking about workforce addition, that has been more than 6,000 this quarter. What is your guidance for the whole financial year? Does it stay as you mentioned in the Q4, it will be like last year?
I think we are going as per plan so far. Going forward, we'll calibrate based on the business situations and decide what to do.
Are you looking for some new growth areas?
We would continuously explore it. We have a diversified portfolio, and that remains.
Talking about TCV, it has been at $9.4 billion this time. How should one read this number?
Well, overall, if you look at TCV conversion, it has been good. If you look at the book to bill, it is at 1.3 billion. If you look at the split, which is in North America as well as the rest of the world, it is a well-balanced portfolio. We didn't have any mega deal, but the mix of large deals, mid-sized deals and small deals is also reasonable. And the pipeline also remains steady.
All right, so that's the TCS management speaking about the numbers and, of course, looking at the growth trajectory of the company. In fact, the management stated that BFSI still remains the largest vertical for the company with a 30.9% share. In fact, the company also stated that all verticals will see growth going forward. And BFSI, like I said, it continues to lead, and it continues to lead discretionary as well. In fact, discretionary spending, the company says, is cautious, and cost optimization is driving demand. So that's an overview of what really TCS is thinking. Meanwhile, TCS also stated that GenAI is moving from value delivery from an experimentation phase, and customers are shifting to ROI-driven GenAI projects. There is strong growth that the company is projecting for AI, cybersecurity, public cloud, and of course investing in industry-specific and agentic AI solutions. Well, ladies and gentlemen, with that, it's a wrap on this edition of Startup Central. Thank you very much for watching.